All right.
All right, let's take a look at the markets right now with Sylvia Jablonski, the CEO and Chief Investment Officer at Defiance ETFs. And Sylvia, there is a lot to kind of dig through just over the last, I don't know, 16, 18 hours or so. What did you think? What was your takeaway from this back and forth about will we or will we not have a blanket deposit protection or insurance on any of these things? Does it matter? And what are you kind of still thinking through with the Fed?
Good morning, Becky. Well, on the Fed, I'll take the second question first. On the Fed, I think that the Fed initially gave the market, what it was expecting, that 25 basis points rate hike, and words like could and should and may instead of ongoing. And, you kind of saw futures immediately rise and sort of like that message. But then, the more that the Fed chair talked about it and talked about, how the goal remains to bring inflation down and there could be more rate hikes and he doesn't see, rate hike or rate cuts in the next year, the market sort of didn't like that. So where we stand there now is, swaps are pricing in 50-50 on a May hike and sort of remains to be seen. So in terms of what the Fed does for the rest of the year, in terms of, pausing and potentially like at least considering bringing down rates next year, I think is going to dictate the market performance in the short term. So, if he does hike again and we sort of ignore the credit kind of crunch or potential crisis that we have and don't let that play out into inflation, I do think that'll be negative for markets. If we get a pause and we kind of look at that data and see inflation coming down and see, what the banking SVB sort of blow up and Silvergate signature, things like that does for inflation. If it does bring it down, I think that will be positive for the markets, although we will have a higher risk of recession there.
Yeah, I was going to say, Sylvia, you're talking about two different things. You're saying if they stop hiking and inflation comes down, well, that's the big unknown, right? Is what's going to happen to inflation without this. So it's not so much what the Fed does, but what the inflation numbers show us down the road.
I think that that's true. It's what the inflation numbers show us down the road. But, the kind of wild card there is what if the Fed sort of doesn't wait to see what inflation shows us and just continues an aggressive rate hike policy because perhaps, he doesn't believe that there was a big impact on what happened with the SVB to the economy and the psychology of investors and things like that. But I just think that that's going to play out in the favor of inflation falling and leading the Fed to potentially at least pause. That's my sense of it.
So in your mind, you're still worried about the credit crunch and what happens with the banking system and less worried about inflation?
I do think that inflation is starting to come down. We're seeing it, we're seeing it kind of year over year. Obviously, it hasn't been linear, but you see it in CPI, you see it in goods, services remain a little hot. Wage inflation is starting to come down a little bit. So I do think that it's moving in the positive direction. I do think that what happened with the banks is going to actually, add to the deflationary pressures there. So I think that that's a positive thing. But, what I am sort of worried about is the psychology of investors and traders. You saw these run on the banks, and I think that can kind of spiral into other things like investors taking money off out of the market and on the sidelines again, and potentially not spending on goods and services and going back to the idea of, sort of a forced recession around the panic of this event. So I do think that there's a big need to instill confidence back in the banking system, whether it's FDIC insurance, whether it's different regulations, whether it's just clarity around what actually happened on a deeper level with these events before we'll get, a sense of whether or not the markets are going to kind of recover from this.